Qualify, Level 5 Diploma in Business Management. Unit, Risk Management and Organizations. Unit Code, T/507/1618. Unit Introduction. This unit prepares learners for working in a commercial environment by providing an insight into the different risk profiles from both an organization's and an individual's perspectives. The 3 units are Understanding Business Risk, Managing Risk, and Innovation and Creativity. The aim is to provide learners with an understanding of what makes an effective organization in balancing out opportunity with change. This unit will involve the learner in developing risk profiles and identifying risk management strategies for selected case studies. These will be available online as used as a means to illustrate the different ways organizations approach change. The course material will be closely linked with creativity and innovation. Learning outcomes. LO1. Review organizations' risk tolerance in different environments. LO2. Develop skills to identify and assess the risk profiles of organizations. LO3. Investigate how innovation can be used to reduce risk aversion in growing organizations. Learning Outcome 1. Review organizations' risk tolerance in different environments. Key lesson objectives. 1.1 Identify and evaluate different business environments and the likely risks of those environments. 1.2 Provide examples of organizations' tolerance to risk-taking and evaluate how organizations can measure tolerance. Business environment. Business environment refers to any kind of internal or external forces which have an effect on the functioning of the business in a positive or negative way. The environment may affect the business to the extent that there may be a need to modify or revamp the entire business. The environment poses threats, challenges, as well as gives opportunities and chance to grow to the business. For the purpose of classification, there are different types of business environment. Primarily, the types of business environment are classified under 2 categories. Internal business environment. External business environment. Internal business environment includes physical assets, human, financial and marketing resources, technological supports, the management, etc. Financial resources represent the financial capabilities of the organization, while physical resources are an indicator of physical assets which include machinery, production plant, and buildings, etc., which convert the input into output. Human resources are a very crucial factor in the internal business environment. The managerial decisions are taken by human resources, while technological resources represent the technical knowledge which is used in the manufacturing of goods and services. Internal environment consists of the factors which are controllable and which can be changed according to the requirements of the external environment. There's been a drastic change in the internal environment in the last decade or so. The contemporary work environment does not help the employees to be more productive, and the internet is your organization that suffers. That is the reason why organizations have started to adopt a more flexible way of working by making necessary changes in the internal environment. External environment is relatively watched compared to the internal business environment. It is composed of various organizations, institutions, and other forces which operate beyond the control of the organization. It is further classified into external micro and external macro environment. External micro business environment. Micro business forces have a major impact on the operations of a business. For example, suppliers have a huge impact on the pricing of the products. Also, a competitive firm will start a price war in an industry which is relatively small, but if the rival firm is a big one, then the competitive firm will hesitate to initiate the price war. Important factors of micro-external environment are suppliers of inputs, customers, marketing intermediaries, competition, public, etc. External macro business environment. The microenvironment factors are the environmental forces which are faced by the organization and determine the opportunities to exploit in order to promote its business, and also present a threat so that it can put restrictions on the expansion of business and its related activities. The macro environment has both negative and positive aspects to it. A very crucial part of macro environmental forces is that they cannot be controlled by the management of the organization, and because of its own controllability, the firm or the organization has to adjust itself in order to adapt to these external macro forces. It is further classified into different types of business environment, which will be identified as economic environment, social and cultural business environment, political and legal environment, technological environment, demographic environment, natural environment, etc. Business risks. Business risk is that portion of the unsystematic risk caused by the prevailing environment of the business. In other words, business risk is a function of operating conditions being faced by a firm. These risks influence the operating income of a firm and consequently the dividends. Business risks are circumstances or factors which can have a negative impact on the operations or profitability of your business. Business risks are generally classified into two major risk factors: internal factors, circumstances or events within your organization, or external factors, those in the wider business arena. It is a threat to the company's ability to achieve its financial goals. In business, risk means that a company's or an organization's plans may not turn out as originally planned, or that it may not meet its target or achieve its goals. Whilst business risks can never be entirely eliminated, being aware of what these risks are and where they come from can help you better manage their effect and steer a course to business success. Strategic risk. Out of all the kinds of business risk, strategic risk has the most implication. It's on reaching your desired goals. If a company's strategy becomes less effective, objectives are not as easily met. This could be down to shifts in customer demand, new competitors, rising interest rates and other changes. Compliance risk. Compliance risk refers to whether or not a company is complying with the laws and regulations that are applicable to the business and the country in which it operates. Financial risk. All types of business risk tend to come with some sort of financial risk. This type of risk refers to the flow of money in and out of your company and the potential for financial loss. Reputational risk. Reputational risk can also be called client business risk, and it refers to the potential for a damaged reputation. A damaged reputation will result in loss of revenue and have other effects on the company. Operational risk. Any failure in your business's day-to-day operations is known as the operational risk. This could be seen in a technical failure, for example. Internal business risks. Often, businesses can be so focused on negotiating perceived threats in the greater business environment that they fail to identify factors within the company which could threaten its success. Stability. The ability of a business to manage its finances, meet its debt obligations and return capital to its investors is integral to its success. A business which is financially stable can grow its profits more easily than one which is not. Furthermore, investors, lenders and employees are more willing to engage with and invest in a financially stable company. In addition, management stability and branding stability contribute to a company's overall impression of being a sound and stable venture. The reverse is true for businesses which are unstable. Instability can quickly lead to decreasing profits and, ultimately, bankruptcy. Organizational structure. How a business is structured can also mitigate or enhance a business's success. It's of paramount importance that a cohesive and efficient structure is established and maintained if a business is to function smoothly and carry out the goals and aims of the company effectively. When assessing how organizational structure might pose a risk to your business, evaluate its job positions, hierarchy, and lines of communication. Politics and mismanagement. Politics and mismanagement. Internal company politics, particularly in family businesses, can be debilitating, causing management and staff alike to focus, not on the market and the job at hand, but on what's happening internally. Taking your eye off the ball can ultimately open the door to competitors stealing your market share. Mismanagement, including a lack of proper control over finances, production, labor, and marketing, results in increased costs for the business, which will affect your business's bottom line. Resources. Having enough financial and human resources is crucial. If your business is lacking in either of these, you will find it difficult to achieve your business goals. Not only does a lack of resources impinge on the nature and scope of the work you are able to take on, but it can also impact significantly on staff morale. Innovation. Whether it relates to product development, marketing and promotion, or staff welfare, innovation is what keeps a business one step ahead of its rivals. A lack of innovation, therefore, can pose a risk to business success as a company becomes stagnant, and irrelevant in a changing marketplace. Incentives. Incentivizing employees could prove to be a business risk, if it's not done correctly, fairly, and appropriately. Make sure that you explore the right incentive and reward schemes for your business. For example, will group or individual performance bonuses, production bonuses, or non-monetary rewards achieve the best results by reinforcing the behavior you wish to see in your staff? External business risks. The economy, whether it's boom time or bust, how the economy is doing impacts on your business. While you may not have control over the economy at large, understanding what drives it can help you manage threats and maximize opportunities. Political legal factors. Changes in government or government policies and legislation can impact on business, which is why business owners need to keep abreast of latest developments. Socio-cultural factors. Ignore these at your peril. Technology. If you wish to remain relevant, make sure that you monitor technological developments in your field and in the wider business sphere. Shareholders. As a business manager, you're wanting to invest any profits for future growth may be at odds with company shareholders who wish to take value out of the business in the form of dividends. Their business approach, which may be more focused on personal than business wealth, can be very risky indeed for a business and requires careful yet firm management. Examples for different business risks and actions that could be taken. Business risk. Action. 1. Assets. Risk to buildings, assets e.g. fire, flooding. Insure assets. Compliance with fire and building regulations. Early warning systems e.g. smoke alarms, sprinklers. 2. Bad debt. Credit checks. Set credit limits. Set payment terms for suppliers. Use debt collection agency. 3. Bankruptcy of suppliers or clients. Check financial background. Use business intelligence agencies. Early warning indicators e.g. late payment. Avoid single source dependence. Good record keeping. 4. Brand fatigue. Use analytics to measure engagement/CTR etc. Provide personalized useful insights. Less may be more. Create creative, entertaining content. 5. Business strategy, poor or becoming less effective. Have a clear vision. Set clear goals and objectives. Regularly review strategy against market conditions. 6. Cash flow. Improve cash flow management. Review costs and inventory. Accountancy software use/replacement. Careful use of long and short-term financing. 7. Competition, aggressive marketing. Gather intelligence and assess risk. Deploy a defensive strategy. Flip the negative messages, e.g. if competitor says your company is too small, push your agility and ability to focus on your customers. Use industry research and advisory firm like Gartner and Forrester to scan for competitive risk. 8. Compliance with regulations, laws etc. Employee training and refresher courses. See legal advice on contracts, new legislation, industry-specific regulations. Create a quality assurance team. Implement more quality and safety checks. 9. Customer satisfaction low. Identify the source of low satisfaction, e.g. is it difficult to do business with your company or is product quality the problem? Use customer relationship management software. Review product quality, increase quality controls, implement CSAT surveys or similar to monitor sentiment, invest in employee including sales training. Risk tolerance. Risk tolerance is a measure of the level of risk an organization is willing to accept, expressed in either qualitative or quantitative terms and used as a key criterion when making risk-based decisions. Organizations sometimes assign different risk tolerance levels to different types of risk, but if organizations use consistent risk rating or measurement scales, then the same risk tolerance level should apply regardless of the type of risk or its source. Risk tolerance varies widely among organizations based on many factors, including the relative risk sensitivity of risk managers and other organizational leaders, the organization's mission, and the nature of its assets, resources, and the operational processes they support. In information security or any other risk management domain, risk managers make decisions based not on the total risk potentially faced by the organization, but on the risk that remains after risk mitigation or other measures intended to reduce risk have been put in place. Setting the risk tolerance ensures the organization makes risk decisions and manages risk exposures according to established expectations. It helps clarify what is and what is not an acceptable risk exposure, and clarity helps the organization to know with certainty what risk exposures it can take and what risk exposures it must avoid. Furthermore, setting the risk tolerance helps the organization to evaluate actual risk exposures against authorized risk exposures, which in turn helps determine whether it needs to do more or less to manage the identified risk or portfolio of risks. When establishing organizations' risk tolerance, it must consider certain key factors such as risk attitude, organization's goals, risk management capability, risk-taking capacity, and cost and benefit of managing risk. Risk attitude. This relates to the willingness to take risk. Are you a risk taker, risk averse, or risk neutral? Suppose there is an investment with an average monetary return and an equal probability that the return will occur or not occur. How much you are prepared to invest on the investment determines if you are a risk taker, risk averse, or risk neutral. If you are willing to invest more than the average return, you are a risk taker. If you are willing to invest less than the average return, you are a risk avoider. If you are willing only to invest the average return, you are risk neutral. Organization's goals. From a risk tolerance perspective, goals set the target to which an organization directs its resources. Differing goals lead to differing risk tolerances. For example, public and private organizations have different owners, goals, and performance measures. This dictates how the organization sees and reacts to its risks. Some risks exist for private sector organizations but not for public sector organizations. Risk management capability. This refers to the organization's ability to manage its risk exposures within the accepted risk tolerance ranges. Risk-taking capacity. The organization's risk capacity determines its ability to assume the impact of an adverse risk event. When setting your organization's risk tolerance, you need to consider its financial capacity to absorb losses related to adverse risk events, the potential impact of adverse risk events on the achievement of organizational goals, and its reputation. Cost and benefit of managing risk. The benefits of managing each risk exposure must exceed the cost of doing so. Each of the above factors must be considered individually and collectively. Risk tolerance is about taking risks within clearly defined and communicated boundaries set by the organization. There is always potential upside and downside of taking risks. Trying to eliminate risks altogether, rather than managing and leveraging them, could harm the organization in the long run. Risk tolerance is the level of risk that an individual or organization targets. Risk management doesn't always seek to minimize risk because risk-taking is the basis for business and personal gains. Instead, the goal of risk management is usually to maximize risk-reward for a given risk tolerance. The following are a few examples of risk tolerance. High-risk investor who is willing to tolerate potential losses of up to 50% of their portfolio in order to maximize their potential gains. Low-risk investor who will not tolerate any potential loss of capital is restricted to relatively safe investments such as insured savings accounts that have limited potential returns. High-risk startup. A startup company is run by individuals with a high tolerance for risk. Although the business may fail, it also has potential to provide unusually high return to investors. Mega projects. A mega project such as a large bridge may have very low tolerance for risk due to its large budget and responsibility for public safety. Such a project requires intensive risk management processes to ensure that its low risk tolerance is met. Professional snowboarder. Most professional snowboarders have a high risk tolerance because it's difficult to acquire superior snowboarding skills without taking any risks. Factors that influence risk tolerance. 1. Timeline. Each investor will adopt a different time horizon based on their investment plans. Generally, more risk can be taken if there is more time. An individual who needs a certain sum of money at the end of 15 years can take more risk than an individual who needs the same amount by the end of 5 years. It is due to the fact that the market has shown an upward trend over the years. However, there are constant lows in the short term. 2. Goals. Financial goals differ from individual to individual. To accumulate the highest amount of money possible is not the sole purpose of financial planning for many. The amount required to achieve certain goals is calculated, and an investment strategy to deliver such returns is usually pursued. Therefore, each individual will take on a different risk tolerance based on goals. 3. Age. Usually, young individuals should be able to take more risks than older individuals. Young individuals have the capability to make more money working and have more time on their hands to handle market fluctuations. 4. Portfolio size. The larger the portfolio, the more tolerant to risk. An investor with a $50 million portfolio will be able to take more risk than an investor with a $5 million portfolio. If value drop, the percentage loss is much less in a larger portfolio when compared to a smaller portfolio. 5. Investor comfort level. Each investor handles risk differently. Some investors are naturally more comfortable with taking risks than others. On the contrary, market volatility can be extremely stressful for some investors. Risk tolerance is, therefore, directly related to how comfortable an investor is while taking risks. Types of risk tolerance. Investors are usually classified into 3 main categories based on how much risk they can tolerate. The categories are based on many factors, few of which have been discussed above. The 3 categories are: aggressive. Aggressive risk investors are well versed with the market and take huge risks. Such types of investors are used to seeing large upward and downward movements in their portfolio. Aggressive investors are known to be wealthy, experienced, and usually have a broad portfolio. They prefer asset classes with a dynamic price movement, such as equities. Due to the amount of risk they take, they reap superior returns when the market is doing well and naturally face huge losses when the market performs poorly. However, they do not panic sell at times of crisis in the market as they are used to fluctuations on a daily basis. 2. Moderate. Moderate risk investors are relatively less risk tolerant when compared to aggressive risk investors. They take on some risk and usually set a percentage of losses they can handle. They balance their investments between risky and safe asset classes. With the moderate approach, they earn lesser than aggressive investors when the market does well but does not suffer huge losses when the market falls. 3. Conservative. Conservative investors take the least risk in the market. They do not indulge in risky investments at all and go for the options they feel are safest. They prioritize avoiding losses above making gains. The asset classes they invest in are limited to a few, such as FD and PPF, where their capital is protected. Ignoring risk tolerance. Investing without considering risk tolerance can prove to be fatal. An investor must know how to react when the value of investments falls. Many investors flee the market and sell low in the process. At the same time, a market decline can be a great time to buy. Therefore, ascertaining risk tolerance helps in making informed decisions and not make hasty, wrongful decisions. Measuring risk tolerance. There are tests that measure risk tolerance to assess how an investor reacts to different types of risk. These tests are designed to give you a general sense of how much investment risk you can accept, and the results are generally considered reliable. Generally, risk tolerance tests fall into 2 categories: investment preference tests and psychological tests. Investment preference tests. Typically, an investment preference test is a questionnaire that addresses preferences for selected investment vehicles. It asks questions about your current financial situation, goals, and past investment experience. This type of test is easy to construct and relatively simple. The disadvantage, though, is that it does not accurately gauge risk-taking propensity because it does not deal with emotional reactions to risk. Psychological tests. Psychological test is a more elaborate questionnaire that attempts to gauge an investor's attitude toward risk. This type of test generally include questions about your feelings or behavior, or it may ask you to respond to hypothetical situations. This method of testing is easy to administer and can actually be fun to take. The disadvantage is that people generally like to consider themselves as risk takers and may not respond as accurately as they should. Lesson summary. In this lesson we have focused on risk tolerance in different environments. The lesson has been started by discussing the business environment. We have explained internal and external business environments as well. Later, you have gained an understanding on business risks. Internal and external business risks have been identified in this context too. Finally, discussion has been provided on risk tolerance while identifying ways of measuring risk tolerance as well. Learning Outcome 1. Practice question. In order to recap this lesson, attempt the following tasks. 1. Describe why organizations measure risk tolerance.